This is a lecture from Open Tuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
So I'm going to remind you now about the sorts of adjustments that you see in a statement of financial position or balance sheet. And later we'll look at a profit and loss. Of course, a lot of this becomes easier when we look at numbers. The sort of thing we might be asked to prepare if we're asked for balance sheet extracts. The one that is most likely is Goodwill. I think that will always be asked for. They could ask for non-controlling interest. They might ask for group retained earnings. They might ask for investment in associate, but it would tend to be the key numbers in the accounts that they're looking at. They won't be asking us to produce an entire statement of financial position. As we mentioned in our notes, if you are really rusty on this, you could look back and look at a basic consolidation in our financial reporting notes. There's no need to look at a complicated one if you're trying to remember how the balance sheet fits itself back together. But here are some of the standard workings that would help us when we prepare group accounts. It's not quite as definitive as it was in financial reporting. Some of you might have learnt to use net asset workings in financial reporting. They may help. I think you'll find that because you're perhaps just being asked for Goodwill, it probably won't help very much. So you can't see this in too mechanistic a way. But clearly, you would want to always draw a group structure, or at least to imagine the group structure just to sort it out. Remember, at law, the group is the parent and the subsidiary. If you're doing group accounts for the parent and the sub, you also have to bring in the results of the associate. So the associate kind of sticks out of the group. The most important working is Goodwill. There are two ways of working Goodwill out because you can have different figures for the NCI, the non-controlling interest, and we'll talk about those later. But the principle, isn't it, for Goodwill is that you look at what you're paying, so that's the fair value of the consideration. If you're not buying the whole subsidiary, you've also got to bring in the value of the bit that's owned by others, the non-controlling interest. Compare it to the net assets. That's the Goodwill. Under international standards, Goodwill is not amortized, but there must be an impairment review every day, and that would give us the carrying amount at the SFP date, or balance sheet date. So that's a very standard working, which you'll be doing dozens of times as you work through SBR. The second standard working is non-controlling interest. This in the bottom of the balance sheet is the bit that belongs to the minority. And the standard working for that is to take the NCI at acquisition. Importantly, it's the same number as you would have used in the Goodwill working. So this number will be the same as that number there. This is what they were at acquisition. It goes up because of their share of profits. And if you're using full Goodwill, it goes down because of their share of impairment. If you've forgotten what full Goodwill is, don't worry, we'll remind you about that in just a moment. So this is what it was at the beginning. Add on the share of profits, and knock off, in some circumstances, the share of impairment. That's on the assumption that you're using full Goodwill, or fair value Goodwill. We'll remind ourselves about that a bit later. The other key working for subsidiaries is retained earnings. You could be doing this for retained earnings, which is accumulated profits, or you could be doing it for other reserves, which are sometimes known as other components of equity. Consolidation is very much like managing a football club. You consolidate all of the assets, but when you show the results in the retained earnings, you say, here are my results of the parent, and here are the results of the subsidiary since I took control. So in retained earnings, or other components of equity, other reserves, we'll always be working with everything of the parent, my share of S's post-tax profits, and my share of associates' post-tax profits. See, it's not that hard to learn, is it? Then, of course, you would have my share of impairment. Again, that's assuming that you're using full goodwill. If it's proportionate goodwill, we'll remind you later, actually all of the goodwill impairment will go through that working. But either way, impairment, and there might also be some impairment on the associate. So goodwill, I think everyone knows back to front. I hope so. Minority or NCI at the beginning plus their share of profits. Retained earnings, parent plus my share of profits since acquisition. Here's equity accounting, or a reminder for the associate. This will come easier when we try some numbers in a bit. Equity accounting, it's a bit like being asked to be an equity partner in a big accounting firm. So they'll say to you, you're now being a partner, you'll get a key to the executive bathroom, again an executive suit allowance, but before you become a partner, we want your money. So when you become an equity partner, I've never been one, so I'm not quite sure, but I'm told that you need to give them some money in the first place, and then essentially that will be inflated by share of profits, and unfortunately deflated if there's some kind of impairment. So what does equity accounting mean? It means what you invested in the first place plus share of profits. There are my basic workings, and you clearly need to learn those. You need to learn them better than your middle name. When you did financial reporting, you would have met sundry adjustments, things like inventory profits and so on. We won't see lots of questions on those at this level because they're happy that you could deal with those, and that's why you passed financial reporting. So you don't need to spend as long worrying about this. Big messages are, though, that when you have a subsidiary, intercompany balances cancel out. Substance over form. So if you're trying to look at the assets of a married couple, again, they don't want to know how much the wife says her husband owes her or vice versa. These things cancel out. In addition, as with the married couple, if you're trying to look at their income, I don't want to know, again, how much Mrs. Perkins is giving Mr. Perkins for the housekeeping or whatever. I'm not interested, again, or if Mr. Perkins sold his Lego set to Mrs. Perkins at a profit, I'm not interested. So we're not interested in intercompany transactions, are we? And in particular, things like inventory profits. If I buy something for 10, sell it to my subsidiary for 15, the subsidiary hasn't yet sold it, well, you don't really want that profit in the accounts. Hence that word, unrealised profits. So unrealised profits need to be stripped out. That will reduce the value of the inventory and reduce the earnings of the company when we do our consolidation workings. So subsidiaries, we cancel out balances and we remove unrealised profits. If you have, again, associates, it's It's a bit later in the notes, but if you have an associate, you won't really have balances, but you still have unrealised profits. So will you get a big question on that section of the notes? No. Will you get a big question on the next session? Yes. So everything in section 5 is very, very, very important. This is all about issues relating to goodwill. Although I've called it other issues, these are very, very important points. We know that goodwill, remember, is the consideration plus the NCI minus the net assets. Consideration could be in cash or shares. If I'm paying in cash, then it's very clear what the value is. If I'm paying in the future, some people call that deferred consideration. It will need to be discounted. So we'd have to discount to present value. But it won't be a horrid calculation. It'll be for 1 or 2 years. Sometimes you have contingent consideration, which might be payable in the future. That might be linked to how the subsidiary actually performs later. Everything must be measured at fair value. It's not about whether it's likely or not, we're just saying what is the fair value of what would be paid. So if you have to pay $1 million, if the moon is made of green cheese, well, what's the fair value of that? Not very much, is it? 1 cent. It might be made of green cheese, mightn't it? You haven't been there. Who knows? Who knows? Fake news and things. So you have to put a fair value on everything, no matter how unlikely it is. So cash consideration, fairly straightforward. If you're paying in shares, which is very common, remember what you're doing there is you're issuing shares to the person that used to own the subsidiary. Again, we would measure that share consideration on the date, again, that we actually take control. It's fixed at that date, so they always use that share price. It never ever changes. So you look at the share price of the parent company on the date those shares are issued. When you take over a company, you may well have to pay transaction costs. So the accountants will charge a modest amount. The lawyers will charge a fortune. The investment bankers will charge a fortune. The question is, do you capitalise those costs? Watch my lips. No. Transaction costs are not capitalised. Transaction costs are expensed in the profit and loss account. That's not like other asset accounting. When you think about other asset accounting, if you buy PPE and you have to pay legal fees, the legal fees are added on to the cost of the asset. Remember, capitalised again means not added to the cost of the asset. Very unpopular, this rule, because if you buy a company that's a load of rubbish, you buy it for $2, but you have to pay $100,000 to the lawyers, that $100,000 has to go through your profit and loss, and that hurts. It reduces your reported earnings. Goodwill, remember, if I come back to the basics, is consideration plus NCI minus net assets. When you studied FR, you'll have noticed there are 2 methods of measuring NCI. You can either use full goodwill or what we'd call proportionate goodwill. And that slightly changes the calculation of the NCI. We'll play with that a bit later when we look at some numbers. The origin of this is that the accounting standard, IFRS 3, was a joint product between the US and the International Accounting Standards Board. They were trying at the time to kind of get harmony, which sometimes has never really been achieved. And the Europeans said they liked proportionate goodwill, which was always the way we did it, where you were only just measuring goodwill on my share of the company acquired. The US view was that you should measure full goodwill, that you should also include the goodwill attributable to the NCI. So they argued, and eventually they said you can do either. Interestingly, you don't need to be consistent. So if in an exam question you took over two subsidiaries, subsidiary A used full goodwill, subsidiary B used partial goodwill, is that acceptable? Yes. You might say, well, that's disgusting. Well, that's your view, that's fine. But the point is, there is no need for consistency when they make this. Is this an accounting policy? Difficult word. I think the word they use for it is they'd say it's an election. You can elect to use full goodwill or elect to use partial. We'll revise the calculation for both later. So goodwill is what we pay. Add on the NCI. Deduct the net assets of the subsidiary. They must be measured at fair value. In theory, if you think about 100% subsidiary, if I pay 5 and I decide the net assets are 3, there's something very wrong, because you just don't pay 5 for something worth 3. If you go to a restaurant and have a meal that's worth 3, you might leave £3.30 with a tip. That's fine and that's your choice. But you don't normally leave £5. And really, what they're trying to make sure is that goodwill should actually be a very, very small number. Because all of the net assets that you acquire must be measured at fair value. And net assets will include intangibles, anything that is identifiable. So if you took over a training company, its brand name, like Kaplan or BPP, would be identifiable. If its contracts with customers would be identifiable. So in theory, goodwill ought to be a very, very small number. But what it does mean is that all sorts of things will be recognised in the group accounts that wouldn't otherwise. Everything is measured at fair value. Brand names. An internal brand name would not normally be capitalised, but if it's part of the goodwill exercise, yes, it will, in the group accounts. Whenever you're thinking about goodwill, the standard rules on contingencies go out the window. Contingent consideration must be measured at fair value. Contingent liabilities must be measured at fair value. Clearly, if the contingent liability is remote, the fair value would be very small. It would be very strange to have negative goodwill. In theory, it can arise, and it does arise in this exam. So if I took 100% subsidiary and I said that the cost was 50 and the fair value of the net asset acquired was 55, you can see that the goodwill has become negative. Now, if you're being audited, the auditor will go back and tell you to do your sums again, because usually it means that the net assets have not been measured at fair value. You think they're worth loads and they're not. So if I buy a second-hand car, I think I've got a bargain. I get it home and find out it's two old cars that have crashed and been welded together. I found out later there's a problem, so it's very rare. If you did have it, theoretically you've achieved a bargain or a bargain purchase. So this would be very rare in life, but not in the exam. So it's a bargain purchase. In respect of that, it's immediately credited to the profit and loss, increasing group reported earnings. When you take over a subsidiary, you're supposed to measure things at fair value. The thing is, you don't really know what the fair value is. So when you move into a new house, it's only after a year that you find that the roof is leaking, that you find that the wall falls down, and the cellar collapses. It's the same with the subsidiary. So you don't have to determine definitive fair values on the date of acquisition. This rule is very, very commonly tested. You have a 12-month window. So here's a scary thought. Can goodwill change in the first 12 months? Yes. Do we worry about that? No, it's fine. It may well change in the first 12 months. It happens because you're taking 12 months to assess what the fair values are. So when you look at the fair value adjustments the examiner sets, sometimes one of them you'll say, well, this is reached after the acquisition date. If it's within 12 months, we'd use the new valuation. It takes time to find out what you've bought. Other points down there, the next two are very common sense. Well, if it's immediate acquisition, then you would have to time a portion. Doesn't really cause big problems in this exam. All the subsidiaries must use the parent's accounting policies. Fine. But the last one is important, I think. And it says here, what happens if you've got non-coterminous year ends? So for example, if the parent's year end is the 31st of December and the subsidiary's year end is the 30th of November, can you still use the subsidiary accounts in November? And in most cases, you can. Would it make the consolidation very messy? Yes, I'm sure you'd have a big headache. But I'm not worried about that because we're not worried about numbers as much in this exam. But if they did have a different year end, well, be calm, just say that's fine. The sub would only have to do interim accounts if the difference was more than 3 months. So those are the adjustments or the key things in respect of goodwill. Please make sure that page, everything on it, by doing question practice, you'll get used to the points anyway, but that page needs to be learned very, very, very carefully. Finally, there's a couple of points about associates, but much less significant, I think, here. Associates, you don't cancel out balances. Well, it was important in FR. It's not so important here, but no, you don't, because you can't, because you're not bringing in all of the balances of the associate. But you would still have an adjustment for unrealized profits. So that's a reminder about the mechanics of consolidation and the logic behind goodwill. What we will need to do next, though, is start to revise and practice the numbers.